Okay, item 5 is the Chief Investment Officer's report. Just as a time check, we'll hear Chris's report, and after the CIO's report, we'll take a short 10-minute break, and then we'll come back with item 6, and we'll see if we can get through item 6 before lunch.
Okay, I'll be trying to be real quick because a lot of this is for the audience, the clients in the back of the room, because I know a lot of them like to report this number to the membership. So assets at January 31 were 161 billion. So we are definitely climbing that wall of worry, which is nice to see. The equity markets, U.S. and non-U.S., touched highs for the year, and in some cases highs over the last, well, in both cases, U.S. and non-U.S., the highest level in the last 5 years on February 4. We don't hit a new high because obviously the first of each month outgo the benefit checks, so our assets drop. So here's the asset allocation, very much in line with targets, the traditional pie chart rather than potentially the new pie chart. And I also show you the graph that shows the growth of assets over time. So I'm looking around. I think she got it, 161. This is in your book. It's just a quick picture of the 2012 calendar year returns. We don't really focus much in on calendar year returns because we're really focused on fiscal year. But with individual investors, they obviously, personally, everybody kind of tends to think on calendar years, so they always want to compare how we do. And then on with other peer groups, and we did beat, I haven't got a peer group ranking, but we did fairly well. The one thing I wanted to point out to you is we underperform our policy benchmark. As you can see, all the other asset classes are very close, if not beating their policy benchmark. The whole difference comes, and we've complained about it before, and complaint's the proper word for it, about the private equity benchmark. We just can't find a better one. But that benchmark, March of 10 to, or pardon me, March of 11 to March of 12, September of 11 to September of 12, up 33%. There's nothing you could have bought last year that was up 33% except Greek debt. So, but you couldn't have invested in private equity and gotten 33%. So it's a case of where the benchmark just really drives us out, and that theme will reoccur as you look at the 3-year return, the 5-year return. All you have to do is look at the end of the chart and look at the deviation between the private equity or the real estate and its benchmark. It has very little to do with how we've invested. It has everything to do about how the benchmark's constructed, and we in the industry are always trying to find a better way to measure it. It is what it is, and we live with it. This is a chart of the U.S. equity market, this in 2012. And I think the big thing to point out is just, and just so the board knows, the white lines are up days, the blue lines are down days. So you can see there were some pretty significant down days. But the market really just keeps climbing that wall of worry. We had some nice rallies up until the summer. So last year at this time, we were seeing the market rally very strongly. But then in the spring, it fell off. We climbed a wall of worry in the summertime, and then concern as we got into the election. But then now we've been rallying back up again. So even though we've had the fiscal cliff, even though there were numerous things we were warning you about last year, the market just kept trudging along. And here's a good picture of just kind of the ups and downs, but the overall trend, as you know, was a positive 16%. Here's a longer-term picture going all the way back to 2006. And part of the point of that is so you can see we are almost back to all-time highs in the U.S. equity market in particular. This is the S&P 500 index. You can see the low in 2009, March 9th of 2009. And how, at that time, board members will remember we came in and we talked about, is the recovery going to be a V? Is it going to be a U? Is it going to be a W? Everybody used words to help describe how they thought the recovery would look on a chart. One of the ones we said is it may look like a square root. And so far, sure enough, it kind of is. Very sharp drop, but a slow but steady climb. So not a perfect square root, but it's been interesting. It certainly has been a faster equity recovery than anyone ever expected back in '09. People all talked about a real long, shallow U, that we would just stay down at that level forever. But we'll see. There are some people very worried about the equity market right in here. There have been a couple of people like Byron Weir, who sat right here and talked to our staff a couple weeks ago. They really fear that a correction is at hand in the U.S., that our market's gotten a bit ahead of itself. So we'll see. It certainly has hit resistance as we've gotten back to that all-time high level. Here's a quick snapshot, which I showed you before, of the returns across the world last year. The U.S. being very strong at 16%, but being one of the weaker regions. Non-U.S. stocks, again, did very well. People with global portfolios did very well. Europe, Germany being amongst the strength. So Japan was the only area that was weak, but Japan has really taken off due to their election. And so if you look at Japan from, say, Thanksgiving on, it's been the hot market across the world. So as we look at into 2013, certainly we have the sequestration and the deficit problems. The GDP estimates are around 2%. They're fairly tight. It's very interesting. Normally, the economists, we see a bit of dispersion, but they're very tight. In math terms, the mode, the median, and the average are right on top of each other. From what we look at of the major economists, Wells Fargo is probably the weakest at about 1.7% GDP. And then there's quite a few, mostly the Europeans that are looking at the U.S. that are up at 2.2 to 2.4. So pretty tight consensus. Sometimes that gives you comfort. I oftentimes look at that and say, well, if they're all on the same side of the boat, they're probably going to be dead wrong. And I hate to point it out, but the last time I saw this was about 2007, where all the economists are like right on the view of what 2008 was going to be and they were 100% wrong. So we'll see. But some of the nice strengths underneath the market, as we pointed out to you, continued improvement in the job markets. We saw that again today in the jobs claims numbers. The housing is definitely building a foundation, and that's why I wanted to put the pun is intended. And then so the general view on equity markets is not a double-digit year, but around 6 to 8%. And again, the low forecast for the equity market is probably Wells Fargo. And then the high forecast is just barely double digits. But nobody is thinking this market will continue at a 16% pace. Corporate earnings just look like they're really flattening too much. So the asset allocation, everything is within its policy range. Fixed income's near the bottom, but even it's within its policy range. Because the equity market has improved, the allocations to real estate and private equity have come down a bit. Also, those asset classes have been spinning off a lot of cash flow. I think private equity has given us almost $2 billion, might even be more than that, in $2.5 billion in positive cash flow in 2012. So that's been nice to see and shows that the market's coming back a bit, the economy. So up in the crow's nest, risks that are on the horizon, pretty much the same ones we've seen before. I thought the internet attack and disruption has been very interesting. You probably have read about in the Christmas time how the Iranians have been credited for not tapping into the banks, but at least bringing down their online sites. Obviously, we're going to see more and more of that. If it is not hard for a bunch of kids to disrupt things or crowd a site so much that it crashes the server, it's just going to be interesting to see how that impacts. Again, the energy grid, a lot of our utilities are driven by over the internet, not just our banking and investment system. And then the one I decided to highlight, I didn't make in red, but I'll bring it up, is the pandemic flu, because I would say, about a third of the board is very sick. So it may not be a pandemic, but boy, it certainly has been a tough flu season. So, and the Iran conflict. I met with the global equity chief of the ADIA pension plan, or sovereign wealth fund. And he really walked us through kind of the Iranian conflict from an Arab perspective. And somewhere out there in April, May, we really will be in an interesting, challenging period. So not just Syria, but Iran, Saudi Arabia is not going to be thrilled with the idea that Iran would be nuclear. So it's not just Israel. There are other people in that rim of the world that are not going to be pleased by that. He was very concerned, and his point was, if you look across northern Africa, starting with Egypt, you really see a change in the views and the Muslim Brotherhood. And his point was, America's got to realize there are two sides to democracy. Gee, democracy's good, but what if people that hate us get elected, as we've seen in Egypt and other places? So he really feels like that is going to be a critical area. And boy, there's certainly a lot of money in Abu Dhabi and Kuwait and in Saudi Arabia, and they're not necessarily going to be comfortable with having their side of the world destabilized. And obviously, they're very well aware there that the United States is becoming energy independent with the oil that we're finding in North Dakota, whether we're doing it right or wrong. And obviously, we can't figure out how to get it from North Dakota to the East Coast or to the South. But if we do, they're very well that the U.S. may get energy independent and what that would mean for their region. So it's quite interesting, and I think while now that's not discussed, I wouldn't be surprised if that really becomes the dominant theme next summer when we look back, and it's very uncertain how that will play out. And with that, the new logo and the new slides.
Sharp.
Any questions?
Sharp.
Any questions for Chris? Seeing none, we'll take a short recess till 10:30. Okay, we're back on the record with item number 6, which is the interview and selection of the real estate consultant. For anyone that's just joined us at the meeting, we had opportunity for comments from the public when we started the meeting, and we'll also take earlier this morning at 9 a.m. So we will also take opportunities for comments from the public at the end of the meeting, which it will be later this afternoon. So right now we're on item 6. Chris, Mr. Ailman,
Thank you.
Introduce the topic.
Yes. I just want to encourage the committee. This is obviously one of your 3 critical investment consultants. Treat this like an interview, like you're interviewing a new employee. You ask the questions. We really have tried to ask them to stay constrained on them talking about themselves, because believe me, they would fill the entire interview time. So we've passed out some sample questions. We've asked Harry and Sharon to at least lead out with the first 2. That way you have a consistent response. You can kind of compare and contrast between these 3 firms. As we've said in the Big 3 email, the investment consulting field is pretty narrow. I think, in fact, all three of these
firms actually work for us. The Callan and Cortland have worked for us, been on the payroll, if you will, as independent fiduciaries, and do individual project work. So if we need a independent fiduciary to look at a specific project we want approved, both firms have worked for us in that regard. Cortland for about 8 years, Callan for about 3 years.
And if you hired them, we'd fire them on that side of the...
Yes, they can only work on one side of the equation there.
But I was going to say, I think all of them have been alumni of the same firm, right? All of our alumna.
Yes.
Anyway, it's intermixed. But so this is your meeting. I mean, your interviews. Mike and I are going to sit in the back. We'll just shuffle them in. They were selected in random order. So grill them. You want to add stuff?
Just so the newer board members know the history of real estate consulting firms here. Before Chris and I got here, a group called Camden & Associates was the consultant. Then PCA was the consultant from about, I think, 98 through 2008. They had 2 terms of 5-year terms. Usually we do a 3-year contract with 2 1-year extensions, and we had PCA. And then we've had Townsend.
Totally at your discretion of what you want.
Yes, but normally the norm here has been 3 years with 2 1-year extensions. And that's about it. So we've told them to keep their presentation to 15 minutes or less, and then open it up to questions.
Hold on a second. Dana?
Real quickly, Mike, has Townsend been in that pool also before they were our consultant?
No, Townsend historically was not interested in doing independent fiduciary work, yes.
It's just consultancy.
Yes.
Alrighty, and then, we did a 3-year with 2 1-year extensions with their last contract?
Yes.
Thank you.
Thank you. We're ready. Thanks.
You want to welcome them and let's keep track of time.
You'll,
I'll just whisper in their ear when they have 20 minutes left. Or 15, we gave them 15, right?
I thought it said 20.
15-minute presentation, then questions.
Just so they,
Thanks.
and obviously it is open session. We have told the other presenters to politely sit in the cafe or the mezzanine and not watch the competition. But when you deliberate, that will be an open session as well. Here, Michael.
Good morning. Good morning. And welcome to the Investment Committee. Just in terms of our format and timing, as you are aware, we have about a 15-minute presentation, Mr. Humphrey, so, and then we'll have questions from the committee. So, Mr. Humphrey, would you introduce or is it going to be Mr. Morgan that will be introducing?
I will be introducing Julia D'Amelio, Jay Morgan.
Your mic on? Is your mic on?
Sorry, press the little button. I'll play right there. There you go.
Julia D'Amelio to my far left, Jay Morgan, Bill Foster, and I am Michael Humphrey. Okay, does somebody have the slide?
I'm bringing it right up there,
Great.
Michael. There you go.
Thank you.
Just press that side to advance.
All right, great. Well, it's a pleasure to be here this morning. Thank you for the opportunity to present to you. I think if you jump right into the first page regarding our firm expertise and our firm overview, you can see a summary of important points on Cortland Partners. I founded the firm in 1995 after having worked with the Townsend Group for 4 or 5 years. The focus at the time that we founded the firm was to provide a real asset or real estate consulting firm to institutional investors. We're independently owned by private employees. We're broadening our ownership right now. We have over 30 staff people, and we're located in 2 offices, and a number of employees work out of their homes. We're located in Cleveland and Los Angeles. We have a person in San Francisco who recently joined us, and we have people working out of their homes as well in Philadelphia, New York City, Seattle, and Raleigh. We've had a Los Angeles office since 2007, and as you'll see further in the presentation, we've been doing work with a number of California funds for some time. We're one of the largest global real assets advisors. We are focused on real estate. Again, that's all we do, 30 people focused on real estate and focused on being a fiduciary. If you look at the most recent P&I ranking of consultants, interestingly, we are the largest real estate-focused firm. We have personnel in the firm who have diverse real estate backgrounds and multinational backgrounds. As you'll see when we go through some of the investment activity, we have a significant amount of global and international investment history. And so as a result, we built a firm with expertise that's not only diversified within real estate, that is people who've got property and asset management experience, as well as valuation and workout. We also have people who formerly lived in Brazil and speak Portuguese, people who lived in Asia and speak Mandarin. We've been a CalSTRS fiduciary since 2003. We've evaluated over 40 investments, totaling over $7 billion. The last point on this page is probably the most important. We are a fiduciary-focused firm. We don't have fund of funds. We're not out there providing investment products. This is what we do. We are a real estate fiduciary for funds like you, and this is going to continue to be our focus. If you go to the next page, you can see the Cortland primary team. I would be the lead consultant if we're fortunate enough to be selected. My background is that I've worked with a number of state pension funds in providing strategy. I was very fascinated by the prior discussion that you were having with PCA. Strategy has been my focus, and focusing on what real estate objectives are important to a board and what is the appropriate real estate role is something that we've really focused on with a number of our clients over the last few years. Some of the clients that I've worked with in the past have included a $300 billion Asian sovereign fund, as well as another West Coast public pension fund, which is our longest standing client, that is since 2000, which is a $10 billion or so plus real estate allocation at this point in time. Now, if you look at Bill Foster, next person down, Bill works on state pension funds and a number of other clients with us. He focuses on risk assessment and risk mitigation. We focus a lot on leverage and risk budgeting for a number of our clients. And Bill has developed some models and things, some very useful tools for our clients, and that's one of the things that we spend a lot of time on. Jay Morgan, to my left, works on a number of pension funds as well. With one of the state pension funds that he's worked on recently, he's helped them to develop a pacing model for getting their assets into real estate and taking assets, importantly, from fixed income and putting them into real estate with the important caveat from the client that we can't lose capital. We can't lose this capital. And so Jay helped design some pacing products there. Jack Novotny, I believe Jack is standing in the back of the room. He's the most recent person to our firm. He lives in San Francisco, has a significant amount of real estate experience, formerly worked with Disney and Sony, and did some development. Julia D'Amelio, who you see at the left, formerly worked at the Eaton Corporation, focused on their pension fund, monitoring performance and making investments. Go to the next page. You can see some of the people that we draw from, and this gives an example of the types of expertise that we have in the firm. Again, all we do is real estate. Steve Novick formerly headed up the asset management group for one of the larger value managers in the country, Erdang. Steve has bought, managed, and sold a lot of real estate in his time. Bo Rogers had a similar experience with the real estate operating company, a platform. It was a European funded platform where he invested well over $1 billion. And the best thing about Bo is he tells us he sold it off between 2004 and 2006 because he was lucky. Mark Rivets and other people that you can see here are people who kind of round out the team. Mark is our Latin American specialist. Again, lived in Brazil, speaks Portuguese. Doug Pouch, who's in the back of the room, is a California disabled veteran. He's also a part of our team. Then you can see Stanley Kim, who's in our LA office and is an analyst and speaks Korean and helps us in Asia as well. If you look at our Cortland Public Fund engagements, you can see approximately 38 billion of assets that we advise on. If you look at our state public pension fund clients, it comprises 75% of our advisory base. If you look with respect to some of the other project-based work, it's been pretty interesting. Again, some sovereign funds as well as international European funds in particular. We recently picked up New York City Pension Fund, and Bill Foster works on that. And with that, I will turn it to Bill Foster.
Good morning. I will try to make my comments pretty succinct. If you look at page number 6 or slide number 6 of the presentation, there are a few graphics that you can see here which kind of highlight, given the previous conversation which you had with the folks from PCA that we saw in the other room talking about trying to measure the amount of risk in the portfolio and protecting the portfolio against the downside. To no surprise, when the market crashed in 2008 and 2009, a lot more emphasis, I believe, went on or has since, because of that downturn, gone on evaluating inherent risks that perhaps weren't thought of as much prior to the market going down. Things including portfolio leverage, concentration, sound investment strategy, which involves looking at capital flowing in, capital coming out, how do we pace, how does the economic environment truly affect investment decisions that we've made. And again, these are just some screen snapshots showing some of some of the metrics and some of the modeling that we've done to help ensure that our clients do not face some of the pitfalls that they faced going, into the market peak in 2007 and 2008. It's been a challenge, but we believe that we're much better prepared for should another market downturn come, in terms of understanding all of the risks that are in a portfolio.
Well, in the lower right-hand corner on that page, you can see a snippet of one of our portfolio models. We do portfolio models for all of our clients on an annual basis. It's a part of their annual strategy review that we couple with a review of research and what the market conditions look like at that point in time. But what this does is it tells us what the contributions and distributions are going to look like and what the portfolio is going to look like, and we plug in risk factors so that we can identify, if we do nothing, what's the portfolio look like in 5 years? What changes can we make? And then we do scenarios as well to tell us if we make certain changes to the portfolio, what is it likely to look like?
Thank you. And on slide number 7 here, obviously it's much more exciting to talk about the whole manager selection process. As we know, the asset allocation or the strategy drives, is it 70, is it 90% of returns? I can't certainly put a number on that. The more exciting thing to talk about is what managers are out there and what each of the managers is doing, which we really view as a byproduct of the whole strategic plan. But slide number 7 just, again, shows a number of graphics the way the previous slide did. The one point I'd like to highlight is, we maintain an online manager database. We believe it is actually the most robust database in the real estate consulting industry. It's over $550 billion of gross asset value. And we are, it's called the Cortland Partners Index, and we are able basically to measure returns of a portfolio and a manager against an industry standard benchmark, against peer institutions, peer managers, and as well as against a relative broad industry-based benchmark. One of the issues about real estate, as you know, is we don't have the benefit of daily liquid benchmarks like the S&P 500 or whatnot to measure performance, but we do track virtually every manager that has offerings domestically and internationally, and the database goes back with more than 20 years of history.
Jay?
As Mr. Ailman said in the previous session, referring to the cycles in the markets, we truly believe that there are cycles in the real estate market that track the macroeconomy. And so we've developed our research process to gather data, analyze data, and package data in a way that helps our clients make informed, information-based decisions. We do that specifically by orienting our analysts and our consultants around property types and market regions so that we can leverage their expertise and help our clients learn about developments in each market. We take that local market knowledge that we've gathered and we use that in our quarterly strategy sessions where we go property type by property type and market by market, where we look for risks to the real estate market within each of those regions or property types. And we also look for opportunities for our clients to exploit in their investment portfolio. These meetings also lead to the effective decisions that we take forward to our clients, and those decisions are aided by both the historical data that we gather and the real-time data that we analyze. A lot of the quarterly strategy discussions ultimately lead to topics that we want to drill into deeper to educate ourselves and educate our clients, and those lead to white papers that we produce on a regular basis to help inform the decisions that we are taking forward to our clients.
Bottom line, you have to couple research with strategy review. And once a year, you need to do that, if not more frequently. And the research has to underpin what is going on in the strategy. And we're not necessarily market timers, but we do believe in having a tactical orientation and paying attention to what the market's giving you and what it may be taking away.
On page 9, the research process is led by our investment committee, which is made up by our senior-most people within the firm, including Michael, Bill, and myself. On that investment committee, all decisions are unanimous, so effectively anybody can veto any decision going forward. So you know that when you're hiring Cortland Partners, you get the full force of the firm behind every recommendation that comes forward. And that includes investment manager due diligence, that includes strategic allocation decisions, that includes the annual business plan reviews that we do on behalf of our clients. Additionally, the committee looks at the risk factors relevant to any of the investment decisions. So specifically looking at market risk factors, manager risk factors, or portfolio fit to make sure that the recommendations coming forward out of Cortland Partners is consistent with the overall objectives of the client portfolio.
Okay. Julia?
So the result of
Thank
what
you.
we've done is we've deployed a significant amount of client capital around the world. Since 2000, we've recommended on more than $56 billion of investments for our clients. And what you'll see is that nearly half of that has been on global and international investments. On the next page, if you look at the annual detail, you'll see that some of Cortland's clients were early investors in the international markets, particularly in China and Brazil. And below, you note that we have significant REAC and separate account platform experience. Represents almost 30% of the capital that we've recommended globally.
Last page is just a brief conclusion. Actively employee-owned firm, and it's going to stay that way. We're broadening ownership. Unfortunately, I'm a recovering lawyer, so we're following that kind of a model, and we think that's the best way for us to move forward. Again, I think the most important thing about us, fiduciary focus only. We're not involved in the fund of funds products or other things that, in our view, may cause some alignment of interest issues. And again, being a recovering lawyer, I can spell conflict. And the one thing that I've realized in my career, including as a lawyer, once you start thinking about that there is a potential conflict, you got one. And what I've realized in this industry is it's difficult to separate some of the different activities, especially if you're on the investment side. We're a real estate firm only. And so you've got 30 plus people focused on real estate. Again, real estate advisory focus, this is what we do. 75% of our assets that we advise on are from funds just like yours. We've got significant investment experience, as you heard Julia say, over $56 billion with $27 billion international and global, significant state public fund experience. We have significant separate account and platform experience as well. It's not something that we've talked about, but it's something that we believe in because it provides cost efficiency and better alignment of interests in our view with respect to real estate. And we've done about $16 billion of recommendations there. We have had a California presence for some time, 2007 LA office, and now we've got a person in San Francisco. And we have been a CalSTRS fiduciary since 2003. In closing, you'd be a very important client to us. And again, it's thank you for the opportunity to present.
Thank you for your presentation. We'll go right to questions, and we're going to start first with the Vice Chair, Ms. Hendricks.
I'm trying to request. There we go. Great. Hi there. Thanks for coming. I just wanted to ask, we have a pretty diverse board. We have a recovering lawyer to my right here, and we have educators. We've got ex officio members on our board, and I just wondered if you could explain how you would deal with an investment board that has diverse technical expertise.
This is the norm for us. This is the norm for us. Most of our clients are comprised of similar types of groups. That is, people who are not necessarily full-time investment professionals, but have been elected by their peers to be on the board and to deal with real estate and other investment decisions, as well as other people who may be on the board who have investment decisions. With one board, we've got people who are non-voting members who are very, very much business-oriented by background. What we do is tune into the board and make sure that when we're doing presentations, we're providing presentations that are meaningful to you, and we don't want you to have to ask questions of us. And so I'll give you an example. With our performance measurement reports, we will tune into the different needs of the constituents who read our reports. With the staff, we will provide all the detail necessary, and those books can be very thick. With respect to the board, we will provide executive summaries that tune into the needs that you have. And what those executive summaries should do, though, is they not only should tell you what the return information is, how you compare to your benchmark, it should also tell you how you're doing in terms of your allocation objectives. It should also tell you how you're doing in terms of your strategy, guidelines, and implementation. And we should be able to do that in a format that's readily readable and understandable. And so what I'd say to you is that's a real important focus for us. If we're not getting through, then we're not doing anybody any favors.
I'll take the next question. What are some of the challenges of overseeing and reporting on real estate investments in the real estate investment program versus, say, other asset classes? You see some of those challenges.
Some of the challenges are, and other people can chime in here. Yeah, we unfortunately have also got an accounting background as well. Worked with one of the then big 8 firms, and the accounting issues in particular can be a real issue because we don't have as much definition. And if you would like to get into the detail, I can. But determining gross asset value, for example, proved to be an exercise with some of our managers for one client. Also, in terms of real estate, because there's more investment in properties, at least with funds of your size, there tends to be more focus on understanding the valuation issues associated with real estate and making sure that that's being reasonably done. I think the most important thing, though, is the alignment of interests and adopting structures that best align interests between you and the managers of the partners that you're doing business with. To us, there have been some clients that we've worked with, a few of them who've made some changes in how they're dealing with aligning their interests, and it's really, over the last 5 to 6 years, provided some pretty good results. Investor control is very much related to that, and with a fund of your size, we would focus on every investment that's made on what's the level of investor control, because one of the things that we found out during the economic downturn was enhanced investor control funds did better. Why did they do better? They tended to have less leverage. They tended to better understand the risks associated with the properties, and we tended to have fewer partners or managers coming hand in hand asking for recapitalizations.
And I'd like to also add to the comment that Michael just made as it relates to reporting. Obviously, I previously, myself and Jay, had general consulting background experience as well, and certainly any of these readily available Wilshire or S&P benchmarks you can pull up on Bloomberg on an hourly basis. But one of the tools that we have used to really try to help overcome some of the challenges as it relates to reporting, we're certainly not going in and doing our own audits or appraisals of properties and opining on whether or not we think it's reasonable, although we have done that. It's not a practice that we do on a daily basis. We do have this database, as I mentioned, that's about $550 billion in size, which literally has hundreds and hundreds of different investments in it. And there have been cases where, we can't drill down to the micro detail and say why a manager's performance is off from where it should be. But I can tell you of issues that we had over the past couple years when we saw the average value fund in our database, for instance, down in 2009 by north of 20%. And then when you start seeing managers sending in their data showing positive 6% returns or things of that nature, if nothing else, what it allows us to do on the reporting side is say, what are the statistical outliers? What's the average return? And if to the extent that a manager is reporting a return that's 5 or 6 standard deviations away from the mean, it sets off red flags that are enable us to dig down further.
And we use historical information in the same context to give us an understanding of what is normal. And that's one of the tools that I think we try and use for all of our clients with trustees of all different backgrounds, because it is important to see, for example, what the NCREIF index has done since inception, what the cap rates are, where we stand today, and what does that mean for valuations? And you put that next to what are capital flows like, and then a proxy for fundamental performance such as vacancy rates, and you begin to get an understanding of the market. And again, we're not market timers, but when you see those types of things indicating, for example, a frothy market, it's time to look at your portfolio and make pacing decisions.
Thank you very much. I would just appreciate the detailed responses. I would just provide suggestion that we want to get to as many questions as possible. So we'll do that. Okay. Ms. Dillon.
That's it. Please forgive me if you address this and I somehow missed it in your presentation, but you have 3 co-leads. What do you envision, or who do you envision being the person that is here at every investment committee? Are all 3 of you planning on being here?
I will be here, and one of the 3 of them at every meeting, and more if needed. I mean, one of the things that we do have is a broad support with diverse backgrounds, and so in some instances, we may bring a person who's got a real spike level of expertise to make sure that we can handle the matter to your satisfaction.
But you would be here every day?
Yes.
Thank you.
Did you want-
Mr.
When everybody else is done.
Yeah, we'll come to you at the end of committee member questions if you want to weigh in. Fine, okay, thanks. Mr. Reyes?
I will assume that you read or you familiarized yourself with our portfolio before you came here.
Yes.
Because you're being interviewed for that. Off the bat, what would you view as the weakness in our portfolio? And please don't look at staff.
I'm not gonna look at it. You're currently 45%, well, my numbers are a little bit dated probably from the ones that you looked at. I looked at first quarter information. You're $9.5 billion opportunistic, 45% of your portfolio. That tells me there's some recovery that has to occur. And that opportunistic investment, guessing, because we can't look back at a pacing model of how you put the money out, but just guessing, you put a fair amount of capital to work in 2005, 6, and 7. We being a fiduciary for you, we saw part of that. Obviously, that has not performed well. So we talked to you a lot about risk return and a lot about the opportunistic exposure. And it's interesting because based on the presentation we saw before by PCA, we'd spent a lot of time talking to you about what is the role for real estate? What do you want real estate to do? Is real estate, I read a lot of information and I saw we want real estate to generate cash flow. And we get that, and we see that with a lot of our clients, and that puts you typically more towards core plus type exposure. But we're 45% opportunistic, so that has to be dealt with. At this point in time, I think if we are mainly focused on looking at income, our value exposure is 21%, the smallest of the 3 groups. We're seeing a lot of core plus value opportunity right now, where in some, you're buying income at a discount to replacement cost. And to us, it makes a lot of sense to be looking pretty strongly at that place in the market. The other thing then is investment vehicle, your $20 billion real estate exposure. We have other clients who are in the same range who are, again, using REOCs and joint ventures, and I know you are using those to a certain degree. With one of our clients, it's over 60% of their portfolio. And it's really performed well for them in terms of providing a more stable return and more cash flow, which is, I think, one of your most important objectives. And then I think in terms of looking at the portfolio, we do a basic risk assessment of how has leverage performed for you? Has it adversely contributed to return over the last 5 years? Where do we expect it to be going forward? With respect to pacing, how are we pacing in? And what do we expect pacing to look like going forward? In terms of core value and opportunistic, you've decided a mix there. There's been a decision that's made, and this is a mix that you have. How is that done in comparison to benchmark exposures, to core value and opportunistic, and more importantly, to the core value and opportunistic exposures that you want going forward, right? What is the right mix? And then we'd look at return volatility. One of the things that we're doing for some of our clients is we're talking a lot about risk budgeting. And we're looking at core return performance, value return performance, and we're looking at the return volatilities, and we're trying to determine whether or not you're getting excess or deficit return. And with that, I think...
Thanks for that. Anything else, Mr. Reyes?
I'm good, thank you.
Okay. Mr. Lawson.
As you know, the membership of this system, this plan, is teachers all throughout the state of California, mostly women, diverse backgrounds all. I feel it is our responsibility to make sure that the experts that we retain, to the extent that we can, reflect that diversity. Can you talk to us about your commitment to diversity within your organization?
Absolutely, it's extremely important to us. I think we've got room to improve, but I will say Ben Blakeney, for example, is probably the most senior African-American person in real estate consulting. And we're proud to have had Ben with us for a number of years. And I think Ben's knowledge, not only from a diversity standpoint with us, but Ben's knowledge of emerging managers with diversity objectives is unmatched in the industry. And so I would tell you it's very important to us from that standpoint. And if you look at cultural diversity going beyond with respect to the way we're investing, you can see the amount of client activity that we have in Latin America as well as in Asia. And so, you know, having that cultural diversity for us, in my view, is mandatory. Otherwise, we can't come in front of you with a straight face and say that we really got the cultural understanding that we believe you need to be a good real estate investor in these markets and regions.
Thank you.
Ms. Hendricks?
I just have one.
And just in terms of time check, we got about 10 to 12 minutes left.
So, as you're interviewing to be our consultant, I think I'd love to hear some of your thoughts about what you see your role as our real estate consultant. What would you imagine, if we hired you the next year, how would you engage with us and what would that look like?
Well, what I would anticipate is that we would work with the staff, work with the investment committee, whatever the appropriate forum is, to assist with reviewing the real estate strategy, the role of real estate within the portfolio, and then reviewing and using our tools that we just briefly mentioned to really analyze the portfolio to the extent that you're not already doing it that way, to provide you hopefully more insight on what is the risk return and what is the risk associated with the portfolio, to see if we can't better articulate the objectives, what the role is for real estate, and then how to implement the real estate investment portfolio going forward. And then to be a big part of the implementation, and that there's lots of issues. I mean, reading some of the history about your benchmarking, for example, going to the Odyssey and then going to the Odyssey Plus for value and opportunistic. I think we could provide some interesting comments there. That's kind of a tough way to do things, and so we talked to you about that. But I think all around provide our tools, hopefully some insight with respect to the strategy formulation, research, an integral part of that, and then the implementation process. And then in terms of monitoring, I think we can provide you with a performance book that you get, I guess, every other quarter that's more tuned into what you need to see. And I think better defines what's going on with the real estate portfolio and helps to focus on where the issues are. I mean, for example, where the issues are with respect to opportunistic exposure, the level of leverage with opportunistic, just leverage levels generally. I mean, some of these things that have significantly impacted returns over the last 5 years.
The only thing I would add to that is you obviously are going to be going through some fairly significant strategic conversations at the April meeting and coming up throughout the year. We obviously wouldn't be leading those conversations, but we would be in tune with those conversations as you identify what your risk appetite is. We would want to make sure that we are incorporating that thinking into the real estate portfolio.
But again, this is all we do. It's real estate, and we would hope to add some value.
Can you talk a little bit about the relevance of ESG policies within, from your perspective, within the real estate portfolio?
Sure, absolutely. Environmental has been somewhat challenging. There has been more offerings recently focused on sustainability, accomplishing LEED designations and things like that. But to be very candid, and I know you've got exposure to one of the groups that kind of was one of the pioneering environmental groups, the results were terrible. And the results were terrible because they strayed from their original investment strategy and they got a little bit too aggressive. Instead of doing just environmental remediation, they got into doing land assemblage and development, and it really cost them. And you and a number of our clients did not have good results as a result. Doesn't mean we shouldn't stop trying, though. The environmental objectives that that group in particular stated were very good for society, and the way we looked at it were good corollary objectives so long as we get reasonable returns given the level of risk. And those types of strategies, and there are other groups out there, and we should continue to pursue that. From a social standpoint, I think the investing that we're doing, for example, right now, with one of our large municipal funds that was hit, the region was hit by a big hurricane that you're very familiar with. And we've been, you want to summarize a little bit about the?
Yes, we have just basically been working on dual objectives. Obviously, as fiduciaries, the role of generating the highest return is of paramount importance. But to the extent that we can work collaboratively with staff at this particular pension fund to bring housing back online that was erased or eliminated because of a massive storm that hit the East Coast region, and use pension fund dollars to generate a return at least as attractive as anything else that they get out there, and work to structure that to do a social good at the same point in time, it's a win-win situation, and it's something we've spent since last November working on, which is actually appearing at the board later this month for $500 million of approvals.
Another example, internationally, in Latin America, one of the areas, the property types that have been targeted is necessity-based housing. And it's one that, for me, has been personally very fulfilling because we do a lot of social good there. Now, collectively, we as a community, and at the same time, there are reasonable returns that can be made. But to see, and I've seen this, to be in a unit that's 400, literally 400 square feet, with a cement floor selling for $17,000 in newly constructed housing outside of Bogota, you begin to see that the cement floor represents a huge step up in the standard of living for most of the people who are buying these, given that they're coming from mud-floored favelas and unacceptable standards in our view. It's those types of activities that we are going to continue to be involved with that we think, from an ESG standpoint, make a real difference.
Any other questions from committee members? Okay, seeing none, we thank you very much for your presentation.
Yeah,
And-
I want to hear.
I'm sorry. Mr. Lanoff.
I know you. Pretty good. Take my mic.
Okay. I had two questions, one involving governance. You stressed the fact that you're willing to accept the status as fiduciaries, which of course I applaud. But could you elaborate a little bit on that and talk about what you think that means and what value that adds if you're hired? And second, can you talk a little bit about governance? We have a strong board here. We also have a strong staff. You obviously have experience at other funds working with both staff and board, but here you'd be working for the board. How would you view that? And how would you view your responsibility and how you would report to the board with respect to the staff operations, that sort of thing?
Regarding us as a fiduciary, thank you for asking the question. And I think we stressed it a number of times in our presentation. To us, that's everything. I mean, this is what we do. What does it mean? You're first. That's what it means. You're always first. We're not going to put ourselves in a position of where our activities at our firm create some misalignment of interest or create, and quite candidly, even the perception of a conflict of interest. And that's just the way it has to be. I'm old enough to know that I don't ever want you to be thinking, geez, Cortland is recommending this because there's some benefit for them. Or even worrying about, geez, is there a different agenda there? That is off the table. And that's why we decided not to do a fund of funds. We had a client come to us with a significant allocation asking us to start a fund of funds, and we said no. And it was because, initially, I got to tell you, initially you look at the fees and you say, oh, geez, that's a great thing. The more we thought it through, though, the less comfortable we were with it, because it would, we thought, get in the way to a certain degree of our fiduciary responsibility, or at least muddy the water. And given the amount of capital and the importance that we have in our view in society in making the pension funds work, there's no room for it. There's just no room for that. In terms of governance, staff and board, working with the board, very much relish the opportunity to work with the board and provide you with the insight that and our experience regarding real estate, and to the extent that we see funds operating around the country and doing different things that you would want to talk about. It's our job to talk to you about those things and to make the real estate portfolio and the inner workings of the governance the best it can be to get the best risk-adjusted returns we can.
Thank you. We have one additional question from Mr. Lawson.
A follow-up to that. To the extent that you would be directly advising the board as opposed to the staff, can you talk a little bit about issues that you might have with respect to advice that had been given in the past or what have you? I mean, talk a little bit about that break. The fact that you do have a relationship with the staff that's been going on for a long time, and now you would be breaking that relationship and advising the board. I think it's really just a follow-up to Ian's question.
No, I hear you, and just so that you know, we've been asked to do this for a number of our clients in the past, and in particular with one client a few years ago where there were some investment decisions that didn't work out the best. We were asked to go in by the executive director and the board and evaluate what happened and come out with a report. And look, I mean, a lot of these staff people are friends. I've known them for a long time. We know families, et cetera. But it's our job to do what is the best thing for the beneficiaries. And we need to take an objective look at issues that arise and come to you with candid, unfettered, objective opinions on what we think is best for the board. And we will not have a problem. We would not have a problem in doing that. We just don't. It's our job. But I do know Mike. I know Chris. And as far as I'm concerned, our job has to come first. And so to the extent that there are tough things to do, or uncomfortable things to do, we'll do them.
Thank you.
Okay. That comes to the conclusion of the interview. We appreciate your time, your comments and responses to our questions, and thank you for being here with us today.
Thank you.
Thank you very much.